everyone. Thanks for joining. I'm here with Fred Gratz of US Energy. And Fred, thanks for joining. Really appreciate you being here. I want to give you a quick update. I know there's a couple videos I have with Fred. He's a good friend, a good colleague. I've been working with him for the past 4 years. He's been at US Energy for the past 10. Good company, 40-year-old, second generation, family-owned company. And I want to dig into a strategy that I don't think I've talked about this with one person that hasn't been like interested and wanted more clarity. And that's the ability to do a 1031 exchange. And I think a lot of times people hear that, and that's swapping, one home for a bigger home. You kind of like swap till you drop. I'm coming from Los Angeles. That's what they do anyway. Just keep building up. But in this case, we're talking about doing a 1031 exchange into mineral rights. And it's really an interesting strategy because the cash flow is different, but the law allows for it. So I wanted Fred, can you just take us through kind of high level, what does this entail? Like when someone says, I want to do a mineral rights 1031 exchange, how exactly does it work?
Yeah, so it's funny, right? Because when we think of the DST or the 1031 market, what do we always think of? Well, just traditional real estate. Because that's what it is.
Mm-hmm.
Same thing. Instead of building up, you're building down. That's it, right? So what does that mean in our world? It's producing all of the production from the minerals that are there. Yes, it could be oil, it could be gas, it could be the liquids. It's all of those other things. But it comes down to one thing, and the tax law is identical. Whether you're 1031ing out of a multifamily area or selling any other kind of real estate, and you don't want to recognize that gain, have the capital sent to a QI, turn it into a 1031, right? And you can utilize the energy space, which has a lot of unique characteristics to it, and get the exact same tax benefits, all the deferral, everything else that you're getting in a traditional 1031.
So when you say a QI, he's saying qualified intermediary, which basically means the way this works, the seller can't touch the money. So someone's going to touch it for the seller and then send it off to the 1031. In this case, it would be, the U.S. Energy. But that being the case, if someone, the question that typically follows up after is, can I 1031 from mineral rights back into real estate, or is it stuck?
Do whatever you want, right? You've got especially with the way we designed ours, when we looked at the space, we saw that there were some unique components to the energy sector that it could offer things that actually the traditional real estate sector cannot. And part of that was just in the structure. Right, it is not a DST, right? It's a direct title, meaning that even though we have thousands of acres that we amass in one contiguous position that thousands of investors own, right? They will act as one, but they'll have their own liquidity. So it's basically like owning deeded property, right? If you own deeded property, it's in your name. When can you sell it? Whenever you want.
Whenever you want.
Yeah. It's the same thing here. So you might own a point something interest percentage of this 3,000 acre tract with several different operators. Technically, you can take it to market and sell it whenever you want. We want people to stay in. And it's not just because we are the manager of the assets. Your economics are going to be far better if you stay in, say, a $100 million fund than if you take your $300,000 and try to take it to market. Right? The numbers are in the collective. So with that said, you still have that liquidity if someone wanted to get out. Right.
So take me through, I know a lot of times we've had other podcasts on drilling and drilling strategies. What's the primary driver of income in mineral rights? Because you don't really have control. I mean, you're just getting money off of what comes in, right?
Well, yes. If you're on the mineral rights, all the current drilling, so the PDP or proven developed production that's currently there, future drilling, right? So if you own the acreage, right? So if you own this plot of land and there's 2 wells on there, but it's permitted for up to say 100, the time that wells 3 and 4 come in line, 7 and 8, 50 and 60, your revenue starts to go up, right? Because you own the land. So you're the royalty owner in that situation. Right. So now as more wells come online, your income starts to go up for that reason.
Right. And I guess the flip side, if I were to say, well, what's my risk? My risk is I'm on wells 1 and 2 forever and nothing ever gets developed. How much of a risk is that?
Well, sure. What does that risk mean? It means you sit in cash flow instead of a 5 to 7 year hold. It could be 10 or 12, right? If $70 oil becomes 50 instead of 90, yes, it's going to take longer for the economics to make sense. It could elongate that life cycle, right? But so it's more of a sit and wait game versus having to see prices move in a direction that will be, I guess, more immediately impactful for your position.
Right. So when's a good time to get into mineral rights? If someone were to say, hey, like a good time to get into when the market's when it's down.
Yeah. And what we like on the macro side, we've liked it because we're kind of in a unique spot right now. Some of the best acreage that we've ever seen or produced in our history has also been what qualifies as a 1031 on the mineral right deals. And it's only because the majors are not completing their own acreage. And there's a lot of reasons for that. The ESG movement, the whitewashing, whatever you want to say about carbon bad and all of that movement. The bottom line is it's keeping capital out of the space. And the capital that remains is not really competing with much other capital. So prices are actually very, very attractive right now, especially in the last couple of years. I don't mean oil at 70 or 60. I just mean in the last 2 or 3 years since we've seen these social movements keep capital out of the space. And then you have COVID that happened before this. So it's been a lot of things that happened to the space to keep capital out. But with that, you started to see some very interesting entry points. But the beyond just the macro entry point, back to the question, I think it's more of a needs based, right? Because with 1031s, you have these 45-day identification periods, these 180-day windows, right? So you'll see people have a very immediate and urgent need now, and they might not have it again for several more years, right? So it's just more situation dependent like that.
Gotcha. So let's say somebody you have 2 wells on your acreage, and one of them is just a complete disaster. They just operationally don't run well. They continue to drill and they continue to produce oil, but they're just really struggling profitability wise. Does that impact your ability to get cash flow? The different owner operators that are on the land?
Hey, hypothetically, sure, it could, but we're looking for the scale, right? So we're trying to, not that we're going to be able to bell curve our way out of this thing just in terms of numerics, but when you're talking about thousands of acres and dozens of partners only doing proven developed production, right? You don't really have, for the same reason we talked in our drilling fund of, hey, I'm not going to get a 7, 8, 10 to 1 return. You're not going to get a 0 return either because of all of the offset data. You're going into known reserves. You have thousands of offset data from, hey, we have an asset, say here, we can look at north, south, east, west, what those other assets have done. You're not going to have a surprise if you drill in the middle of those other 4 assets of, oh my gosh, what happened? That's just not how it works. The science, the technology today. Now, look, a well might produce a 2x instead of an ideal 2.2x, right? Or could come in at 1.8 instead of a 2x over time, right? But there's not enough risk in the style of assets that we develop to get outside of those bands, for better or worse.
Right. So take me through. I'm going to ask the question I ask every time. Why haven't people heard about this strategy before?
Yeah, I mean, it's probably one of those things of if it's available, right? If it's not available to you, if it's not in your orbit of, say, you're a financial professional, your CPA is not a specialist in DSTs or 1031s, then why would you be exposed to it, right? You're not out there searching for oil and gas mineral right deals. It's one of those things that are very small in nature. And I mean small, we'll do $100 million of this stuff this year ourselves, out of, say, a multi-billion-dollar industry. But compare that to the mutual fund industry, or God forbid, the ETF industry, right? Where you have hundreds of billions of dollars of liquidity every single day versus a billion or even less that happen in an entire sector over a year. It's just something that people don't see all the time because it's that at the kind of at the end of that financial bookshelf of what they'll use day to day, more on the tax planning component.
I think it's important for people to also understand these are not all, I know you're talking about the size not being huge, but you still have really big players that are in this space. These are sophisticated strategies. I know a lot of the mineral rights have been bought by pension funds. I mean, you've had people put in tens of millions, hundreds of millions, per one ticket. So these have really kind of been reserved as a strategy for kind of the ultra net worth, higher net worth people or funds, if you will.
And I think that's true because in that orbit, right, Eric, the 8, 9 figure and up, the endowments and up, they're as close to the deal, if I can use that term, as it gets, right? They're not looking for a team of individuals that are out there underwriting things, and then a firm that's underwriting the things that those guys see, right? So they're just looking for direct access. So that's kind of where we specialize in for high net worth and ultra net worth investors, is providing them access directly to these strategies and these portfolios. So you're not seeing a fund of funds, so to speak, right? And we saw that was a problem with the private equity model, where they might have this 2 and 20 kind of a PE structure, but by the time the retail investors got their hands on it, it was closer to a 4 and 40, right? Because of middlemen and everything else. So we're just looking the way to kind of carve that up and offer a much closer access point for our investors to partner with access to these types of portfolios and strategies versus having all kinds of shelf space and middlemen in between. That just makes it more expensive and chaotic for the investor experience.
Yeah, I think it's a super crucial place to start too. The access to this. I think before you educate somebody on it, you have to even have access to it. So it'd be a really fun conversation to have, I guess, at a cocktail party to talk about potentially doing this. But unless you have a way in, it doesn't really matter. Yeah, it's just a hypothetical conversation, and you guys do a good job of that.
We don't work with retail investors, and I mean, not that we don't do, to your point, endowments and some of those other institutions that come with 8 figures or more on a per investment basis. That's not most people, right? People are looking for, hey, how does my 50,000 that I need or my 100,000 that I need play for me? And unfortunately, those doors have been largely closed to them. So we're looking to carve that out.
So what is the minimum that someone could put into something like this? And I guess what's the maximum that someone could put into something like this with you?
Sure. I mean, so you'll see in all of our units, it'll say $100,000 across per share class. That's just because it's a private security. We are limited in our investor count. We don't care. If one investor needs millions, one investor needs less than one unit, a partial unit, if that partial unit solves their tax puzzle piece, that's a phenomenal play for us, right? As far as maximums, that's going to be very personal too. You don't really have one on the 1031 space that you would say another kind of bucket or another tax maneuver that could have some other limitations other than your exposed gain or the asset that you're coming out of.
Right. What do you see and again, I just want to say this, preface this with, past performance does not equal future returns, but what have people historically seen in this mineral rights area with regards to expected cash flow?
Yeah, that was one of the more attractive things about it because of the cadence in the timing of cash flows in the energy sector, that you were seeing cash flow start relatively quickly. It starts day one. Now, it might take a few months for that to get kicked in and actually received by investors, just because of all of the titling and everything that we have to do. Again, if it's deeded property and you own thousands and thousands of acres, we have to go to all of those county clerks and do all of that filing thousands of times over for each investor. So there's a lot happening here. But with that said, we're seeing, and it depends on the tranche too. We have some assets generating income in that 5 to 7% range. We have some in the low double digits, 10% plus.
Gotcha. And I think those are really attractive numbers. And from a cost basis standpoint, how is the income taxed? So I'll give you like a simple example. Let's say somebody had $1 million 1031 they sent to you, and their cost basis off of what they came in was 400,000. And just to make the math easy, let's say the thing's kicking out 10%. So they get $100,000. Is that full $100,000 taxable? How does that income come into?
Couple things. So the short answer is, for 1031 and any 1031, the answer is it depends, right? It depends on, to what you just said, what's your outside tax basis, right? So what's unique in oil and gas is you're going to have depletion allowances, which will give you 15% of the income tax-free in perpetuity, right? You'll have depreciation. You'll have some other scheduling of some sheltering of tax that you will not have in other sectors. But over and above that, right? So back to your example, right? That 400,000 that first came in, that is also going to be 400,000 that is going to be tax-free on the way out, right? Because you'll be able to write off your basis as you go plus the depreciation, right? So depending on what the math is for each individual, you're always going to have some tax-free income. Any 1031 is going to have that ability, but it all comes back to what's your outside tax basis, right? So you'll write that off first, and then after that, you'll see those other tax benefits kick in.
Nice. So it's tax advantaged income. You have the ability to shift money, between, real estate to actual oil and gas or mineral rights, and then back if you'd like. It's still tangible. It's completely liquid if you wanted to, because you'll be the deed of title holder.
I think a good way to wrap this up is that it's probably it's probably not the only pony an investor wants to utilize, unless it's a very small investment, right? But for those that are in most 1031s, they're pretty sizable. 5, 7, 15 million. You see a lot in that area. With that said, this is probably something that's a good partial solution, right? It's probably a good partial solution because you're going to have someone that's always been in real estate. They're always going to own real estate to some extent. But if they want something that's going to cash flow sooner, that is going to have probably a higher yield, especially for the next several years, then this could be a great way to take a 3, 4, 5, or a 6 cap. I'm not bashing a 5 or a 6 cap on the real estate side, but if they can help juice that return and pairing that with something that's generating 8, 10, 11% somewhere else, it could go a nice way beyond adding just diversification to juice the cash flow as well.
I like it. I want to wrap this up by saying thank you, Fred, for coming on and giving us some color on this. I'm going to have some links below this video that'll take you to a couple white papers and some additional details, some other links to some tax law and stuff. So if you want to vet this and do a little more, due diligence on your own, we'll provide some links to do that. And as always, Fred, appreciate you. Thanks for taking the time, and I look forward to talking to you soon.
The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.